You checked your account this morning and saw it. $35 gone. Not stolen, not spent, just taken. The bank called it an overdraft fee. You called it Tuesday. This happens 4 billion times a year in America alone. 4 billion moments where money vanishes from the poorest accounts and reappears in the richest vaults. This is not a glitch. This is not an accident. This is the final evolution of a taxation system so old that emperors used it to fund their wars. Let me take you back to medieval Europe. The year is 1284. A merchant in Florence needs to move his gold across hostile territory. He cannot carry it himself. Bandits control the roads. So he goes to a man who sits behind a bench. The Italian word for bench is banco. This is where the word bank is born. The man behind the bench makes a promise. Give me your gold. I will keep it safe. I will move it for you. I will even let you access it in another city through a letter of credit. The merchant agrees. He signs a ledger. And here is where the trap springs. The man behind the bench adds a line to the contract. If you make a mistake, if you withdraw more than you deposited, if you miscalculate by even a single coin, you will pay me a penalty. Not a small penalty. A penalty so large it erases any benefit you gained from using my service. The merchant has no choice. He signs. The fee system is born. But this system did not start with banks. It started with emperors who needed to control their soldiers. Ancient Rome had a problem. Soldiers who got paid too much became dangerous. They bought land. They bought loyalty. They started coups. But soldiers who got paid too little deserted. So Rome invented something brilliant. They paid soldiers just enough to survive, but they added a twist. Every time a soldier made a mistake, every time he lost a piece of equipment, every time he failed an inspection, they docked his pay. These were called stoppages. The word still exists in military payroll systems today. The soldier could never save enough to leave. He could never accumulate enough to become independent. One mistake and he was back to zero. The system kept him hungry. The system kept him obedient. The system kept him in uniform until he died. This brings us to stage 1. The lure. You are told that you need this account. You are told that without it, you cannot function in modern society. No direct deposit, no online payments, no building credit. They offer you convenience. They offer you a debit card with your name embossed in plastic. They offer you an app that shows your balance in real time. What they do not tell you is that the app refreshes faster than the actual clearing system. What they do not tell you is that transactions can post in any order they choose. What they do not tell you is that they have already calculated exactly how many mistakes you will make per year. They have your income. They have your spending patterns. They have algorithms that predict your breaking point. You think you are opening an account. You are actually enrolling in a mistake monetization program. Stage 2 arrives when you make your first error. You thought you had $50, you had $47, you bought coffee for $3.50, the transaction goes through. You feel relief. Then you check your account that night. Negative $2.50 plus a $35 overdraft fee, your coffee cost you $38.50. But here is the part they do not teach you in school. That negative balance now sits there. Every purchase you make in the next 3 days will trigger another fee. You buy gas, another $35. You buy groceries, another $35. You have now paid $105 in fees on an initial shortage of $2.50. This is not interest. Interest would be regulated. This is a penalty system designed to multiply faster than you can recover. The medieval guilds perfected this model in the 13th century. If you wanted to learn a trade, you became an apprentice. The master craftsman promised to teach you, but he also charged you for every mistake. You burned the bread, you pay. You cut the leather crooked, you pay. You mixed the mortar wrong, you pay. These fines were called breakage fees. The apprentice could work for 7 years and still owe the master money at the end. The system was not designed to train craftsmen. It was designed to create permanent debtors who could never leave the workshop. The modern bank account is the same workshop. The fees are the same breakage charges. The only difference is that the master now wears a suit and calls himself a chief financial officer. Stage 3 is the dependency lock. You now need the account more than ever because you need to fix the problem the account created. You need direct deposit to come in so you can cover the negative balance. But direct deposit takes 3 days to clear, even though the money leaves your employer's account instantly. Those 3 days are not a technical limitation. They are a design choice. The bank uses your money for 72 hours before you can touch it. They call this the float. In those 72 hours, they invest it, they loan it, they multiply it. Meanwhile, you are paying fees on a balance that is only negative because they are holding your own money hostage. This is not banking. This is a protection racket with a vault. Let me show you the math that makes escape impossible. The average American pays $250 per year in overdraft fees. If you make $30,000 per year, that is 0.83% of your gross income. But you are not taxed on gross income. You are taxed on net income. After federal tax, state tax, Social Security, Medicare and health insurance, your take-home pay is roughly $22,000. Now the $250 is 1.14% of what you actually receive. But it gets worse. That $250 is not evenly distributed. It hits in clusters. One bad week can cost you $150 in fees. That is 0.68% of your annual take-home pay gone in 7 days. And here is the part that breaks you. That money is not deducted before you pay rent. It is not deducted before you buy food. It is taken after you have already committed those funds. So now you are short for next month, which means you will overdraft again. The cycle is not a circle. It is a spiral, and it only goes one direction. Stage 4 is the normalization. You stop fighting it. You start calling it life. Your friends all pay these fees too. Your parents paid them. Your co-workers pay them. The bank starts offering you solutions. They offer you overdraft protection. This is not protection. This is permission to charge you even more. They will link your checking account to a savings account and transfer money automatically when you overdraft. They will charge you $12 per transfer. They will let you overdraft up to your direct deposit amount. They will charge you $35 per overdraft. You are now paying for the privilege of borrowing your own future money. This is not a financial service. This is a payday loan built into your checking account. The Medici family ran the same scheme in Renaissance Florence. They were not just bankers. They were mistake farmers. They loaned money to noblemen who spent more than they earned. When the nobleman missed a payment, the Medici did not seize his land immediately. They added a fee, then another fee, then a penalty on the unpaid fees. The debt grew faster than crops could pay it down. Within 2 generations, the nobleman's grandson was working for the Medici as a debt servant. His title remained, his estate remained, but the Medici owned every coin that passed through his hands. The modern term for this is debt peonage. We pretend we abolished it. We just moved it from the cotton field to the checking account. Stage 5 is the trap within the trap. You try to escape, you try to switch banks, but here is what they do not tell you. Check Systems exists. It is a banking background check company. If you have unpaid overdraft fees at one bank, every other bank can see it. They will reject your application. You are now unbanked. You cannot get direct deposit. You cannot cash checks without paying a fee at a check cashing store. Those stores charge 3% of the check amount. If you make $30,000 per year, that is $900 per year just to access your own money. You tried to escape the $35 fee and walked into a $900 fee. The cage does not have one lock, it has 1,000 locks, and they all require the same key. Money you do not have. This is where the system turns deadly, because now you are vulnerable to every predator in the financial ecosystem. Payday loans, title loans, rent-to-own furniture. They all target the unbanked. They all charge interest rates that would make a medieval usurer blush. The Catholic Church once banned interest above 10% and called it a mortal sin. Modern payday loans charge 400% annual interest and call it a service fee. The terminology changed. The extraction rate increased. The sin became a business model. Stage 6 is the generational trap. Your children watch you pay these fees. They learn that this is normal. They open their first account at 16. The bank offers them a student checking account with no monthly fees. What the bank does not mention is that overdraft fees still apply. Your child makes the same mistake you made. Buys something for $3 when they have $2. Pays $35 in fees. The trap resets. The cycle continues. The bank does not need to advertise. The system reproduces itself through financial illiteracy passed from parent to child like a genetic disease. But here is the part that should make your blood cold. The banks know exactly who will pay the most fees. They have your zip code. They have your credit score. They have your transaction history. They know that people who live paycheck to paycheck generate 10 times more fee revenue than people with cushions in their accounts. This is why banks close branches in wealthy neighborhoods and open them in poor neighborhoods. This is why they offer free checking to people who maintain minimum balances of $5,000. They are not serving the poor. They are farming them. The branch in your neighborhood is not a bank. It is a harvesting facility. The numbers do not lie. In 2023, banks collected $15.4 billion in overdraft fees. That is billion with a B. 53% of those fees came from 9% of account holders. Those 9% are not the careless rich. They are the desperate poor. They are people who overdraft more than 10 times per year. They are people for whom $35 is the difference between electricity and darkness. The system is not broken. The system is functioning exactly as designed. It is a poverty tax collected by private corporations and protected by federal law. Let me tell you what federal law says. It says banks must allow you to opt out of overdraft coverage. It says they cannot charge you a fee if you decline the coverage. But here is the trick. They can still charge you a fee for bouncing a check. They can still charge you a fee for automated bill payments that try to process. They can still report you to check systems if you leave a negative balance unpaid. Opting out does not free you. It just changes which trap you fall into. You either pay the bank or you pay the phone company's reconnection fee. You either pay the bank or you pay the landlord's late fee. The choice is not freedom or servitude. The choice is which master gets paid first. The Roman Empire called this tributum. It was a tax paid only by conquered people. Roman citizens did not pay it. The conquered paid it every year. In grain, in silver, in labor. It kept them weak. It kept them controllable. It funded the legions that kept them conquered. When Rome fell, the system did not die. It migrated. The feudal lords collected it and called it corvée. The colonial powers collected it and called it the hut tax. The company stores collected it and called it scrip. The banks collected and called it a service fee. The name changes every few centuries. The mechanism is eternal. You are living in the final stage of this system, the stage where the trap is invisible. Your great-grandfather could see the company store. He could see the scrip that was worthless outside the mining town. He knew he was being robbed. You cannot see it. Your money is digital. Your fees are electronic. The robbery happens in milliseconds while you sleep. You wake up poorer and you blame yourself. You call it a mistake. The bank calls it revenue. The truth is somewhere in between. You made a mistake, but the punishment was designed to be catastrophic. The mistake was real. The penalty is theft.